Good morning, everybody. It seems like the markets are, well, kind of bouncing. I think we were a little bit higher earlier on in the day. Right now, S&P sitting at 658. The Qs are at 590 and the Dow Jones at 464. Good morning. Welcome. Welcome, everybody. Right. So I think we are seeing this move up because of the potential for de-escalation in the Middle East. I'm not too sure whether or not you have actually seen the latest reports coming out from Iran that they actually have their own 5 conditions before they would even consider ending the war. So I think there is a lot of noise right now, and I think the markets isn't too certain about which direction it should go, whether or not it should go up, or whether or not it should we should they should take us down even further. Now, if you go on the daily time frame and you look at the SPY, this morning the SPY broke above the 200-day moving average over here. But I think the question right now is whether or not it can stay above the 200-day moving average. So I think even if we see a close today above the 200-day moving average, I would think that we at least need a full candle above the 200-day moving average before we can have a little bit more confidence that this is really at least trying to be a reversal all the way up to at least the 680 range. So whether or not there's going to be a broader correction and all that, we don't know. But for the short to medium term, I wouldn't be surprised if we actually break this level to go back up to the 50-day moving average. Good morning, everybody. All right, give me a minute. I think my settings on the live stream is off. Give me a second. Let me just double check. All right. Okay, we should be good. All right. So today, basically, it's going to be a hopefully slightly shorter stream because I have to wake up early tomorrow. We are going to talk about the portfolio primarily because I actually added a position in, at least opened a small starter position in one of the companies that we have been looking at. I'll take you through my thoughts on its valuation, and then we'll talk a little bit definitely about Bitmine's Maven strategy. I don't think we have gotten that much information around Maven, but we will see. Give me a minute. Thank you for the 8 of you being here. Good morning. Good morning. I hope your portfolio is as green as the market is today. It seems to be, at least for now, holding above the 200-day moving average. So that's all good. Let's take a look at this news piece on. I think this is what is causing a little bit of fear in the markets right now, which is why we were up a little bit more this morning. But as of right now, you can see that the demands that Iran is making, it's it's something that I find it very hard to believe that the US is actually going to meet these demands. They want a complete halt to the aggression and assassinations by the enemy. I mean, this I can definitely see happening. The second one is that they want an establishment of concrete mechanisms to ensure that the war is not reimposed on the Islamic Republic. Again, this is one of those that, okay, perhaps I can see this happening, but what kind of concrete mechanisms? The verbiage that is being used right now is still very ambiguous, very vague, so we don't really know what they mean by that. You know, yeah, I can't really think of what they mean by concrete mechanisms. Now, the third condition that they set forth is going to be something that I feel is not easy for the US to actually agree to. They want guaranteed and clearly defined payment of war damages and reparations. And I really do not think we are going to see that in the I don't think we are going to see that from the US. I mean, the US basically just obliterated most of their infrastructure, and the reason why they do that in the first place is because there is concerns. I mean, whether or not you believe it is a completely different issue, but there are concerns over Iran's ability to launch a nuclear attack and to basically use their riches rather than to help their citizens do well. They actually use it to fund terror within the region. So I think it doesn't make sense that the US and Israel attack Iran, and then after that give you money to go and fix all the stuff that is broken. I think they wouldn't mind Iran taking years to go and fix some of the damages so that they will have less money to go and fund some of the terror activities around the world. So that's why I say I don't think the third thing is definitely. I don't think the third thing is something that I can see the US and definitely not Israel agreeing to. The conclusion of the war across all fronts and for all resistant group involved throughout the region. I mean, it's like asking Israel to stop fighting with Hezbollah. I think that's also going to be pretty hard. And you can see right now, even with this, they're not concerned just about their own citizens. Iran is concerned about, you know, the other terrorist organizations within the region more than their own people, apparently. So that's why they do not want the stoppage of the war just in their homeland. They want a complete conclusion of the war on all fronts and for all resistance groups. So again, I feel like this is unlikely to happen, un- pretty unlikely. Not, I don't think it's as unlikely as guarantees for war damages and reparations, but it is fairly unlikely. I don't think Israel is going to let off against Hezbollah anytime soon. And the international recognition and guidance regarding Iran's sovereign right to exercise authority over the Strait of Hormuz. Now, after what they have demonstrated in the last couple of weeks, I really, really doubt anybody will want to give them sovereignty, to exercise authority over the Strait of Hormuz. It's not just the US and Israel over here. I believe the other Gulf countries are unlikely to want to give them this sort of authority over the Strait of Hormuz as well. So I think what I find pretty interesting is that all of these things seem to be coming up from an Iranian state-run press TV, but they cite official statement, but we don't really know who. I do believe that they had a picture. Let me see. Do they have a picture? I believe they have some sort of a picture of or a name of who Donald Trump was negotiating with. I'm not sure. Okay. Yep. So anyway, I think that is all we have for the Iran update. I am partially wondering whether or not this is just a distraction tactic for the ground troops to get closer to Iran, because right now, if they fight, um, basically it's going to be very hard to target whatever Iran is doing in the Strait of Hormuz, especially if they're using smaller boats to plant mines and things like that. No matter how big your aircraft carrier is, the moment that you're confined within a very narrow strait, you are susceptible to attacks by all these smaller, more nimble crafts. And I don't think that that's what the US wants, and it's likely why they are waiting for their ground troops to come. However, I think the moment you see ground troops in Iran, firstly, that day will likely be one of the worst days in the market, which historically that tends to be the time to buy. However, at the same time, I do think if we do see boots on the ground, I would think that the midterm elections is probably going to be lost at that point in time, because I don't think uh, even now I find it quite hard for Trump to convince the citizens in the US that this war is beneficial to them, especially if oil prices continue to rise, especially if we see inflation back above 3%, which thankfully we are not seeing that right now. But that is the narrative that the Democrats are going to be spinning leading up to the midterms, and it's going to be very hard to go against that because of recency bias. I think people will remember the effects of the war and the high oil prices and things like that. So the reason why I'm bringing up the midterms is because one of the companies that we are invested in, Bitmine, is closely tied to certain policies being passed before the midterm. There is a risk that if the Clarity Act is not passed before the midterms, then it might not be passed at all. So this was one of the risks that people were talking about. how real it is, if you look at poly markets at the moment, poly markets still give it a 70% chance of passing. So I think it is perfectly fine. All right. So I hope all of your portfolios are green right now. Give me a minute. All right. Okay, so let's go back to take a look at what the markets are doing, different sectors, and then I'll talk a little bit about what we are doing with the portfolio today. Okay, we have already made some moves. I should have sold the covered call before I came online on SoFi, but right now, seems to market seems to be cooling off a little bit, at least for some of our positions. So let me just jump back very quickly to. All right, so S&P is up. Okay, so we're up a little bit more from where we were this morning. We are up around 1% right now. Uh, like I said, I would prefer to see, or I would need to see a full candle close above the 200-day moving average before that signals any sort of reversal, because another news report could come out at the end of today, and then the next thing we know, we open below the 200-day moving average again. Still too early to tell. The Nasdaq, despite it being up nearly 1.2%, it is actually still struggling below the 200-day moving average. So that is why I do think there is a lot of apprehension, a lot of tentativeness in the market right now, and I think this has to do with the uncertainty over whether are we de-escalating or whether or not this conflict is escalating, right? However, if you take a look at the VIX is down today around 7%, which is good, but it's still range bound. It is not coming down. It's not breaking the uptrend by any stretch of the imagination. I think it is likely, if this trend persists, that we start to see this come down to 22, 23, and then it bounces back up again. All right, this is the Singapore index. Right now, markets are closed, but tomorrow, for those Singapore viewers, right, look for a break above the 50-day moving average. I mean, if you take a look at the Singapore index, historically, it hasn't been so. If you just take a look at this on the weekly candle, usually the Singapore index doesn't trade too far away from the moving average. This spike over here has to do with the run that we saw between 24 and 25 due to the high interest rates. My concern with people buying this run or buying this index over here is that eventually there will be some form of correction. Maybe not so soon. Maybe as the moving averages rise up, I don't think we are going to see like low 3,000s again. But I wouldn't be surprised to see some correction, perhaps in the 4,000 ish dollar range, right? In the perhaps medium term. All right. Okay. Now the US 10-year Treasury, we are seeing this still firmly above 4.3. I was pretty happy that this actually went down to 4.1 or even 4% just a couple of weeks ago. But unfortunately for us right now, this is all the way up. And as the 10-year Treasury goes up, it adds a lot more pressure onto stock prices. Similarly, the 2-year is spiking. I think there are some inflation fears around oil prices. So this is only natural. Gold is up nearly 4%, and silver is up 5%. But silver has already been cut in half. Basically, the high for this year is around $110, and right now we're at 66. So we're down over 40% on silver. Good morning. Thank you for the 20 of you over here. Right. So on top of this, the we actually bought Ethereum through this iFast Ethereum ETHA. Basically, we bought this at I think 1605. So right now, because Ethereum has somewhat recovered to the 2200 or close to the 2200 range, this is up from where we have bought it. Again, I have kept this staked Ethereum ETF on our watch list, because in time I wouldn't be opposed to shifting it over here. But you can see we barely have any volume in the options chain, so it doesn't make much sense for us to use the staked Ethereum ETF at the moment. Right. Let's see. So far is up 2.5% today. I think we were up slightly more than that. Robinhood is up 7%. Why is Robinhood up 7% today? I thought I would really get a chance to buy them at around $70. Oh, okay. Oh, Robinhood shares jump after company announces $1.5 billion of share buybacks. Okay, no wonder. So let me just share my screen with you guys. Right, this is likely why we are seeing Robinhood up around 7%. Board of Directors approved a new $1.5 billion share buyback program will be executed over the next 3 years. So around $500 million every single year. I think this is a good move by Robinhood, considering where the markets are right now, because in all likelihood, I think in all likelihood, should we see a broader correction, there is a chance that Robinhood falls below $60 into the $50 range. And I think they want to have cash on hand in order, or they want to have the approval ready so that they can basically buy the dip on their own company should that happen, and at the same time support the EPS. I saw a meme that says Donald Trump and Iran at talks, and then it was just a pic of him pointing and talking to a mirror. Good morning, good morning. Yep. So this is why Robinhood is up. I'm not too sure whether or not this kind of pump will actually last, because if you take a look at the Robinhood chart, we are still hovering in kind of like no man's land. Oops. What happened to my camera? Did my camera just die on me? No, my camera's working. Give me a second. Let me share my chart and then let me go fix my camera. Right. So, okay. Can you guys hear me? I think so, right? Projecting. All right. This is my MacBook camera to show whether let me go back to let me just try this again. I have no idea what's up. Give me I think it might be the connection. But you guys can hear me. It's just that you can't see me, is it? If that's the case, I'll just switch to my MacBook camera because my camera is on for me. I just don't know why it can't see me at the moment. Is it working now? At least you guys can hear me. Oh, okay. There we are. Fantastic. The tech is wonky this morning. All right. So as I was saying, for Hood, I think what we are seeing right now is a retest of the 0.618. And I think for me, when I look at this, it just tells me that there's a lot of uncertainty still. If we do break past this 74 level, then perhaps I'll be open to uh, opening. I'll be open to just buying above this level if we can establish a base above it. Otherwise, if we cannot break past this level because it really, really touches right at the 0.618 line, then I think we are still in no man's land. And if we're in no man's land, I think my concern is that should there be any volatility in the markets, or should there be any negative developments in the conflict in the Middle East, we are likely to see this come down all the way to the $50-$60 ranges, right? I don't think anybody wants to see that. I think there is some level of support around the mid 60s, between $66-$68. But again, that shouldn't be a very strong support. We might see it come lower. However, like I said, Robinhood's not raising, the passing of the approval to buy back another $1.5 billion worth of shares, definitely incredibly bullish for the company, and I think it's as a safety net should we see more softness in the markets, right? So I do think that this 7% sale might get sold off, especially if we do see some sort of uh, uncertainty in the markets. So that's with Robinhood. Now, Zeta Global, uh, as with every time I open a position, the moment I execute a buy, and this was the position that I actually bought today, the stock came down. So it went all the way up to 1708. I believe I made a purchase around 1682. So if you can take a look, let me see. I bought today at 1682, I believe. Let me see. Let's go all the way to 22. Zeta Global, 200 shares at 1682, right? So the reason why I ended up buying Zeta Global is because I think as I took a deeper dive into the company, it really showed that fundamentally they are a very strong company. And I understand although I have my concerns, especially around the stock-based compensation, but at the same time, I do understand the strategy that they have pivoted into. And I'll talk a little bit about that in a bit. Okay, so that's for Zeta. Right now, I just want to take a look at the covered calls for SoFi because at least it's up by 2% today. Might want to take advantage of this to sell some covered calls slightly further out of the money. Let's take a look at the position. So if we take a look on screen over here for SoFi, where I hope to sell a covered call might be around this $20 or $21 range at the 50% retracement level. I think that should make a pretty good level to sell a covered call across the next maybe maybe in the next 1 month. So from here, that would mean at least a recovery of close to 20% in the next month. I do not think, with the kind of market conditions that we have right now, that we are likely to see a 20% recovery in the space of a month. So this could, like I said, be famous last words. Now, on the 1st of May, if you take a look at the covered calls over here at $20, you end up getting 46 cents, which is not too bad. Right, considering my average is 1796, which I wouldn't be, which means that even though I might be forced to sell, we are selling at a $2 profit per share. So that's fine actually. It's not that I would completely exit the position. Of course, in all likelihood, I'm going to roll it out. But there's also another possibility that I just let the position get called away and sell cash puts right at that level, depending on the momentum of the company. So let's do this. Let's sell an option for 47. So I'm going to do this only on 10, basically 10 contracts, which is 1,000 shares, because I am not confident that we will not pass this level. I think there is still a slight possibility that we might go past this level. So 10 contracts, 47 cents per contract. Let me submit it. So this is going to be due on the 1st of May, which is 37 days later. So let's fill this, use all of these details and fill up the Excel spreadsheet. All right, so if I go into the spreadsheet over here, hopefully you guys can see this clearly. Let me, SoFi. Okay, so with SoFi, today it is the 25th of March. And what we have just done is that we sold a call expiring on the 1st of May with a strike of $20. We sold 10 contracts and price per contract we got 47 cents. If we get a sign, was it a sign already? Did we already get a sign? Okay, we are still waiting for assignment. I think there is a chance we are getting a sign depending on how the market plays out. I might just shift this down to 46 cents. Premium received, let's just drag this down. This will calculate for us 470. And this is currently an open position. Of course, the price of the contract is around 46 cents. Intrinsic value, this will do its own calculation. Okay, no problem. So because the intrinsic value is negative, it's going to be taken as 0. Extrinsic value, it's basically the entire value of the contract, which means 100% of the contract is extrinsic value, which means we are in the safe zone. Now, to me, where I will start to keep watch is when the extrinsic value falls below 20%. And I think when it falls below 10%, then that's when I would really consider rolling the position or basically injecting more cash into the account to take profits. However, like I said, in this account, we are not going to be injecting cash unless it's the beginning of a new year. So therefore, in that scenario, we would have to roll the position. The date close, unsure yet, but tentatively, we're going to put it on the 1st of May so that we can count the total number of days. So from now until the 1st of May, there's 37 days altogether. Assuming that this just closes by itself, all right, the collateral is basically for a covered call. Usually, I just count the collateral as my cost basis, which is around $17,960. And if you work that out, that turns out to be a monthly yield of around 2.1%. Okay, so whether or not we make a profit on this trade yet to be determined. We have to wait for the 1st of May. But if let's say the 1st of May happens, so far it's trading below $20 per share. We keep the entirety of this $470, and that actually gives us around a 2.1% yield for the month, right? So with that, and if once we close this position, you can actually see that this brings down our adjusted cost basis to $17.21. And I just noticed that SoFi had a very big fall off. Suddenly it just fell from 17.20 down to 16.95. So I don't think we are getting a sign. Give me a second. Let me go back and take a look. Okay, so are markets correcting in general, or is it just SoFi? Okay, I'm not going to adjust the price just yet. I just want to see what happens in the markets right now. Because markets seem to be correcting a little bit. We just fell in the S&P from being up 1% to now we're back down at up just 0.7%. So if you take a look, S&P, we're kind of falling, are we? Down 0.65. Any news come out? Let's refresh. No, we do not seem to have anything new come out. Did Trump post on Truth Social? Let me see. Unlikely, right? I guess if the market falling, it's unlikely to do with Trump posting anything. Likely to do with Iran denying some of the things that Trump wants to post. All right. I think right now, we really sold the cover call at a pretty at the wrong time. Really, this is falling right now. Let's see whether this gets a sign. Like I said, if the premium doesn't make sense to me, and I'm getting less than 0.2%, then really I'm not in a urgent need to go and sell the covered call. Happy to wait, at least on this portfolio, right? So let's take a look at the numbers. In our portfolio, SoFi, from being up 3%, okay, we basically bounce right off the 1720 line over here. Again, not a surprise. This is the 618. The iShares Ethereum. Okay, 1633. Robinhood is back down 773. Zeta Global. Wow, what a fall off. What a fall off. Okay, we actually got in at 16.80, so we are down around 60 or 50 cents per share. Like I said, you never know what's going to happen. I'm perfectly fine buying at these areas. So I think for the rest of the portfolio, I'm not going to be making any moves right now. I'll be in Singapore all the way until next Monday. So I think what's likely going to happen is that I will just leave the portfolio as it is, and then we will just enjoy the theta decay as long as it stays above certain price ranges, and then we will close it as close as possible to the 2nd of April, which is likely going to be next Monday. All right, now I'm going to take you through a little bit of a rant, or not really a rant, a discussion about why I decided to open a position in Zeta, despite all of the fears around software companies in general at the moment. Now, let me pull up my spreadsheet for Zeta. Okay, let me share this with you guys. All right, so when it comes to Zeta, I think this is a very interesting name. I've always maintained that, I didn't expect myself to get into Zeta for the very simple reason that I've always felt that this was one of those companies that was popularized on X, and I thought it was kind of like I wouldn't call it a meme goal as far as to call it a meme company, but it was one of those that was overly hyped up on X, and there's really nothing fundamental to it over here. Now, the first column, what you're seeing over here. Okay, give me a minute. Let me pull up my notes because I can't remember everything offhand when it comes to Zeta. Does anybody here have Zeta in your own portfolio? All right. So the reason why Zeta is actually pretty impressive to me because they actually serve quite a number of the Fortune 100 companies. I believe they serve around 51 of the Fortune 100 companies and 120 of the Fortune 500 companies. And they also just posted, I believe, 18 consecutive quarter of beats and raises, and I think 16 consecutive quarters of like over 20% growth. So that is pretty impressive. I don't think many other companies in the US stock market can actually claim to have done that recently, at least. Um, so I think it is misunderstood because it finds itself set in a very awkward place between marketing and which is, definitely at risk of any potential recession due to the high oil prices. But at the same time, they can also be considered under software. So they're kind of being whacked in both ends. So if I were to break this down for you, I believe Zeta actually sells software to some of the biggest companies in the world. And we're talking about, they have their arms into a lot of different sectors of the economy. They serve banks, they serve airlines, even travel companies, and they help these companies try and figure out who their customers are, what kind of platforms their customers are on, and how to best reach the customer in a way that will encourage the customer to come into their or to buy more of their products and services. So they do that by using their platform known as the Zeta marketing platform, and it's made up of a couple of different products. Now, the first one is email and messaging. This is the most direct and most basic feature that they have, and basically it's not just someone sitting there helping you to email people. This is a massively scaled up AI version of like MailChimp, right? I think most of you have heard of MailChimp before, but it's basically purpose built for enterprise to send out hundreds of millions of messages every single month. So it does handle things like email, SMS, push notifications. And the AI doesn't just send messages, it actually picks which consumer should end up receiving them and basically helps to optimize every single part of the message, including the line items as well as the subject line. And at the same time, a bit like what YouTube does, YouTube actually shows me what time most of my audience is online, which is when I choose to post my videos. And so this is exactly what Zeta helps the companies that work with them to do, to identify the best time to actually reach out to their audience. Now, the second part of Zeta's marketing platform is their CDP Plus. This is basically their data network or their data platform, where they have amalgamated all the data across a number of years. Now, to understand this, you have to understand how Zeta started. I believe they started back in the late 2000s, around 2007, 2008. And during that period of time, they actually scaled the company through acquisitions. They bought a lot of smaller enterprise software companies and pieced together the different softwares and then basically put together the whole Zeta marketing platform product. That was how they started. And what they actually realized over time, or what the CEO David Steinberg realized over time, is that this was not sustainable in the long run. Right, you are going to be outcompeted fairly easily by a lot of competitors, and I think that at the end of the day, because he's worried about the trend of where the company is going, plus the potential disruption of AI, that a couple of years ago he decided to rip it all apart. He took a number of engineers with him, and he decided to rebuild the company from scratch. Oh my goodness, from scratch. Okay, from scratch. And so that is where they turn their focus to really build their data platform. And I believe this is a key differentiator for Zeta and their business, because they have their own proprietary data on top of whatever the companies that they're working with already have. And because they serve so many different brands in so many different sectors of the industry, whatever that is being trained on, their AI is being, whatever data, sorry, that their AI is being trained on can be applied to the multiple different brands that they work with. So in some way, this, I'm not saying that this is the next Palantir, by the way, no, but I'm just saying that in some way, this is very similar to what we saw with Palantir previously, where Palantir told us, whatever we learn from helping one company, we can actually make use of this knowledge to actually better serve future companies that continue to work with us. So this basically forms its own network effect, where the more people Zeta work with, in this case, the more attractive the more attractive their entire business becomes. All right. So on top of this, they also have their advertising platform. This is basically the demand side platform where the brands go to buy targeted digital advertisements. So I will do a more detailed video on this in future. But basically, at the end of the day, the strategy for the company is very simple, right? From these three products, usually the company will pick one or two of the products to work with Zeta, perhaps email marketing or messaging, and through those or that one particular stream of advertisement or marketing, what tends to happen is that Zeta over delivers. They actually over deliver to the point where the companies see a 6x return on their advertisement spend. And because of that, they choose to expand their relationship with Zeta. I just want to share with you one of the most important screens from Zeta's earnings. And this basically tells you this really, at least to me, in my opinion, shows me uh, the upside for Zeta. Let me just share my screen over here. All right. So if you take a look on Zeta's presentation, you can see 19 consecutive quarters. Okay, this is the scaled customers expansion. This is basically talking about their customer growth. Okay, this is the slide over here. They have very powerful revenue leverage as customers ramp up to over $1 million spent every single year. So you can see over here, this is the the group of customers that are spending between 100,000 to 1 million $1 million, sorry, every single year with them. And these customers tend to drive a quarterly average revenue per user of around 104, basically $104,000, right? And on average, they have around 1.9 channels, so slightly under 2 channels, which means most people in this group are using 2 marketing channels, whereas there's a small minority still using only 1 channel working with them, which is why they're between 100K to $1 million. Now, what I think is that a lot of these companies that are using only 1 marketing channel, perhaps they are the newer companies within Zeta's ecosystem, and it takes time for them to build up that relationship. Now, what is particularly impressive is that although you can see, the revenue from here scales to from 100,000 on the low end to minimum at least $1 million spent every single year, by right, the revenue actually only grows by around 10x. But what we are seeing actually happen in practice is that the revenue tends to grow around 17 to 18x between one category to another. And this is particularly important because when you take a look at the skilled members later on, you can actually see that the skilled members are growing. Super skilled members, which is members paying above $1 million, these members are growing at a particularly fast pace. And they are able to do that because they are all working with over three of Zeta's marketing channels. Okay, so this is basically, at least to me, very simply put, the thesis around Zeta. So going back to that screen, my all right. So going back to this, you can see that the skilled customer growth, uh, over time, this has been coming down to around, last quarter came in at around 10%. Previously, it was single digits, kind of re-accelerated a little bit. But what is important for you to see is the skilled customer as a percentage of overall customer count. Now, in the past, this was in the high 70s, close to 80% range of all their customers spending 100,000 to $1 million. However, right now, this has fallen all the way down to just 69% across the last 2 quarters, and their super skilled customers make up over 30% of their customers. Now, this is important because the super skilled customers are actually growing faster than the actual customer base themselves. So you can see total customer growth is around 14 to 20%. So you call it an average of around 17%. But super skilled customers spending over $1 million with a 17x revenue opportunity, is growing at 24 to 23%. So you can see a very strong focus by the management team to truly monetize their business. Over here, average revenue per user, this has been increasing steadily across the last couple of years. And the remaining performance obligation, this suddenly spiked. But this spike really has to do with their acquisition of Marigold Enterprise. So a lot of the RPOs actually come from there. But actually, when you see or when you understand Zeta's business, they're moving more towards a usage model. Now, in the past, when analysts look at companies, they like to look at recurring revenue models because it makes the revenue a lot more predictable. However, with Zeta's own data, I think what they realize is that when you lock people into a contract, what tends to happen is that they tend to spend up to the point where they have taken back the value from the contract, and then they stop spending. But when you spend on a usage basis and you are making or helping people make a 6x return on whatever they're spending on advertising, Zeta actually realized that their customers tend to spend more with them on a usage basis compared to just purely recurring revenue. And so because of that, they have decided to change their business model a little bit. And over here, you can see that this has definitely worked out with a net revenue retention of around 128%. I believe in some reports they show 120%, so I have to double check that figure. Right, even 120% is particularly impressive. I think anything above 110% net revenue retention is actually a very good number for the business. So if you are just looking at the graphs at the bottom, you can see over here, skilled customer growth, they tend to move in a little bit of cycles when it comes to the growth of the members. I think a lot of times they might be focusing on scaling or expanding their relationship with existing members, and perhaps during those periods of time, the focus isn't really on acquiring new customers, but actually expanding relationships with existing customers. And then after some time, they will refocus on growing customers again. So that's why we tend to see this kind of volatility in customer growth. But when you take a look at the bar chart itself, you can see the chart is definitely up and to the right. Okay. And on top of that, the customer count, and if you overlay the trend of the average revenue per user, this has basically scaled from just around $200,000 to just over $600,000 per user. And this yellow bar, like I said, represents the super skilled customers, which are the customers paying above $1 million every single year to work with Zeta. Right? And remaining performance obligations are here. And these are just the customer breakdowns for the individual customers. Now, from here, if you take a look at their numbers, you can see the total revenue. If I zoom this in just slightly, oh, if you take a look at the numbers over here, you can see in 2022 they were growing at around 24%, and they have maintained this growth rate nearly every single quarter, all the way until Q4 of 2025, and they are projected to still grow at around this pace for the rest of the year. Now, in first quarter of 2026, I'm not sure whether or not we are going to see a decline in revenue. The reason why I've put 50% is very simple, because when you take a look at Zeta's revenue, it is pretty cyclical. So, 50% 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 is pretty cyclical. So, Perhaps they grow at 40% over here. I don't know whether or not that is actually reasonable. 40% growth, and then they'll start scaling from there. 30, something like that. Okay. I haven't really dug deep dive into the projections. I've just used management's projections and taken their word for it. But I think you can see that their revenue is pretty cyclical. If you just take a look at the trend here, Q1 lesser, Q2, Q3, Q4. And this trend of increasing every single quarter from Q1 to Q4 repeats itself year on year. So you can see from Q4 to Q1 every year, there's a slight drop off, and I'm expecting that this year as well. So don't pay attention to the projected numbers, because the projected numbers are really, it was just there. The formula was just there, so the numbers just auto populated itself. I'll have to take a deeper dive into the projections to see whether or not we can come up with our own projections. But for now, I'm just going to take management's word for it that by 2028 they plan to reach around $2.8 billion in revenue. So this is slightly under. I would presume that they would have to grow a bit more. Oh, even then it's slightly too slow. Okay, let's assume 30%. Yep. Okay. With this assumption, you get to around 2.8 billion. Now, like I said, don't take this too seriously. I'm just using management's numbers, and they projected that we are going to get to $2.8 billion in revenue by 2028. And on top of that, free cash flow, they are projecting around 370 to $380 million in free cash flow. I can't really get to that number without decreasing their margin, unless they plan to stay at 16% margin flat forever, at least for the next 3 years. Then I can get to that number. But otherwise, if you think that their margins will start to improve, because this quarter they actually came in at 16% margin. So unless you expect them to maintain this quarter's margin for the next 3 years, otherwise you actually come in a lot higher than their own projections of around 370 something million dollars of free cash flow. So that's why I think it is reasonable to expect them to at least increase their free cash flow by 1 percentage point, which is why I'm using what I'm using over here. So using all of this, you can see the trend. Their free cash flow, despite them being net income negative, they are losing money. They have managed their free cash flow extremely well, and you can see they have been free cash flow positive all the way since 2021, even though they were restructuring their business. And I think this is a sign of an extremely disciplined company and an extremely cost efficient company, something that makes me a lot more confident about the management team, because I would say that I am pretty familiar with like the Tom Lee's work. I'm pretty familiar with how Anthony Noto works at this point in time. And I'm not as familiar with David Steinberg. Now, I've listened to one or two of his interviews, but I'm not particularly familiar with him or the competency of the management team. But looking at this, around how he manages the cash flow tells me a lot about the principles of this management team, that despite being net income negative, you can display cash flow positivity during this period of time while you're scaling your business, while you're turning around your business. I think this is particularly impressive to me. So when you take a look on a multiple basis, what is happening is that the market cap right now, because of the price, I believe what $16.14. Okay, this basically makes the market cap around $3.9 billion. You add the debt that is on their balance sheet, around $109 million. Take away the cash, you get an enterprise value of around $3.8 billion. All right. Now, for us, we're not using a EV to EBITDA moment, because the debt and the cash positions are not significant. What I will actually be using is a price to free cash flow as well as their PAC ratio. So again, you can see in 2028, the expectations is that they come in at around $2.8 billion in revenue. Again, just want to show you, not pulling this number out of thin air. Where is it? Let me see, 2028. Oh, sorry, 2.3 billion dollars. 2.3. Okay, this makes a lot more sense. $2.3 billion. That means Yep. Okay. $2.3 billion. I think we have changed it correctly now. Am I right? 2.3. Yes. Okay. So $2.3 billion, which represents 25% growth in 2026 and then 20% growth across the next couple of years. So let me just pull this so the formula writes itself. Okay, so $2.3 billion, net income of around $336, and with shares outstanding, I am assuming a 3% dilution every single year. Now, the dilution has actually been pretty bad when you take a look at it on a quarterly basis. Again, I'll do it in the deep dive, but today I'm not going to go so deep into this right now. And from here, you can see that their EPS is expected to come in at around $1.26 by 2028, should they actually put up these numbers. And with a free cash flow of around 17.3% free cash flow margin, that takes you to around $407. So, like I said, unless you expect their margin to stay flat for the next 3 years, otherwise, we should come in at around $407, which makes free cash flow per share come in at $1.53. Now, taking you to the left hand side over here, you can see price to free cash flow in 2027. Again, like I said, basically you can call out any single date, and the number will be pulled out from that table that you see at the bottom. So the reason why I didn't use 2026 is because right now they are not EPS positive, and so when you use 2026 on the PEG ratio, you don't actually get a positive number for the price target. Hi, Lawrence. Well, technically it is still good night because it is 11:30 p.m. It's going to be good morning soon, but I actually have to head off a little bit earlier today because I have to wake up at 7 a.m. tomorrow. I have a meeting in the morning to rush to. But I've been talking about why I decided to add Zeta to the position, and I think I added right at the point where they started to drop off. So I'm reaching the point where I'm discussing the valuation of Zeta at the moment, and right now where we are is that using management's own guidance that in 2028 Zeta's revenue should come in at around $2.3 billion, net income margin 14%, but I think the most important one is the free cash flow margin of around 17%, because today in the fourth quarter of 2025, they just reported free cash flow margins of 16%. So we are just expecting a 1% increase across the next 3 years, which I think is perfectly reasonable. Sleep is overrated. I also think so. Right. So that's why, yeah. That's why after this, I'm still going to, after I'm finished with the stream, I still have to go exercise before I sleep. So because of that, the free cash flow per share is around $1.53. And when you pull it up, okay, depending on which year you're using. So if you're using 2027, you can see that with a 30-time price to free cash flow, which I think is fairly reasonable for a company that is growing at this pace, the price target would be around $34.54. And in 2027, if you're using a 1 times PEG, the EPS growth would be around 258%, which is pretty significant, which means the P ratio, assuming, and I think 200 plus P ratio is actually perfectly fine because they would have just turned EPS positive, right? They would have just turned EPS positive for the full year by the end of 2026. So I don't think this is really too far out of the imagination. We have seen this happen multiple times with Palantir, with Robinhood, even with SoFi, that when they just turn full year profitable, the EPS ratio, the PE ratio can be pretty ridiculous. With that number, that actually gets you to around $49.21, which puts the aggregate price target at around $41. Now, if you take a 20% discount to this, you still end up with a price target of $33, which means buying today, you should be able to double your money across the next 2 years if it plays out exactly as what the CEO predicts. Is Zeta a direct competitor to Trade Desk, in my opinion? Not really. They have certain overlaps. Now, the Trade Desk works primarily on the demand side. They basically help people to buy the different advertising spots. And how Trade Desk does this is that they actually use cookies to do that. And the problem with that is that Google and Apple are trying to regulate cookies, and so because of that, Trade Desk is finding it harder and harder to actually link up their customers with the advertising spots that generates them the most return. Now, for Zeta, how they have built the company initially was something that I was a little bit uncomfortable with, but over time that has proven to be a moat for the company because since 2007 they started acquiring different marketing software enterprise companies that were smaller than them. They take on all of their tools and then they divest the rest of the company. And so whenever they do that, they actually have this bunch of data that they have, or this database that they have been building since 2007 from all different industries. And because of that, they are actually pretty well diversified and have their own proprietary database that actually works on top of whatever the brands already have. So they are not reliant on cookies. Even if cookies completely go away, they already have 15 years of data. And I feel like this is in some ways pretty similar to what Palantir was doing previously. Hi James, do I work in finance? Sort of. I used to be a primary school or elementary school teacher, depending on which part of the world you're from. I think people call it different names. I think perhaps that's why can explain stuff in a slightly different way. So yeah, anything to be very honest, most of the stuff I know about finance, I picked it up across the last 7-8 years when I was self teaching myself how to invest. Now I work in finance, but I usually do like portfolio management kind of thing or estate planning for some people, rather than any sort of yeah. Like I'm not really like I don't do the analyst job, although I am planning to take the CFA. But yeah, most of it is self taught. I work mostly most of the knowledge I picked up along the way as I taught myself how to invest. But yes, I thought that the Muddy Waters report was quite disingenuous. I think if you are on X, you actually see a lot of the people with a lot of insider knowledge come out and rebut the report using actual facts. Now, these are data that we do not have. But even as a retail investor, you have to understand how SoFi's business work and why not it actually makes sense. Why because what Muddy Waters is arguing is that they do not have certain or proper disclosures over certain things. Now, these are things then that if you have followed Timothy Sweeney and even Mizuho that came out, they actually helped SoFi to defend their position. These are things where we don't really have that insight into all of these data. But what we do know as an investor is the thought process of the business. And so in that particular example, understanding risk, one of the things that a lender wants to hedge against is counterparty risk. And there is a risk when you're lending to 100 per people versus one very credit-worthy person. So because of that, I do think these are things that over time you just pick up along the way as you learn how to invest on your own. Good morning. Good morning. Right now, we're just covering the last part of the Zeta valuation. I'm going to turn this entire segment into a more detailed video to give you my full thesis on Zeta. A couple of you has been asking me about it. I have just opened a position in Zeta this morning at around 1680, and I'm looking to buy all the way down. I thought I would get a chance to buy lower 16s, but seems to be bouncing back. Thoughts on Grab's buyback program? Also, uh, yeah, their short share is at all-time high. I think we've grabbed that. So next week, when I am in Vietnam, I've already heard you guys the two videos that I'm releasing, and it's going to be pre scheduled beforehand. It's going to be on Zeta and Grab, and I addressed partially about the share buyback as well. I think we've grabbed their share buyback program. I think they themselves are bullish on their company. They do think that in this $3 range, really the valuations are pretty ridiculous. If you think about it, they are a $14 billion company with nearly $7 billion of cash on hand, which means half of their market cap is cash, and so that's why it's pretty ridiculous. Now, since I am talking about the Zeta valuation, which I just showed you, comes in at around $41 over here. I just want to quickly touch on Grab at the same time, and you can look forward to the entire video next week. All right. So over here, if we have no more questions around Zeta, I will just pull up the Grab spreadsheet. I think the buyback program signals that the management team is actually bullish on Grab themselves. Let me just share my screen over here. This is Zeta, right? Where is my Grab? Okay. This is the Grab spreadsheet. Let me take a look. Where is the valuation? Yep. All right. This is the Grab valuation over here. Basically, we are using EV to EBITDA. Let me see. Is my numbers correct? I think I got a different. I haven't updated. When in Vietnam, make sure to use as much Grab as possible. Definitely, I want to pump up I want to pump my own bags as well, right? In Singapore, I don't use them enough, so I'm definitely going to be using them every day in Vietnam. And apparently, there's also Grab bike, which is quite interesting for me to try to sit behind a motorcycle. Selling Zeta puts, there's an old gap at around 12.50. Interestingly, that is where the FIP retracement ends up as well, around the $12 range. I do not know whether or not we'll get there. If we do, fantastic. I'll be happy to buy at those prices, but I'm just going to be buying on the way down. I think at least in the public portfolio, Zeta is going to be one of the slightly bigger positions. When I say slightly bigger, I mean double-digit percentages, right? So like perhaps 10 to 12%, which means $10,000. So $10,000 is like maybe around 800 shares. So right now, this is really just a starter position, 200 shares, and we'll see how it goes. Sorry, let me take a look. I believe some of my numbers are a little bit off because I haven't updated the spreadsheet. Okay, you know what? I should just share this screen with you. Give me a second since you're asking about Grab. Because I've already done the calculations, but I think I haven't updated the spreadsheet. Where is my, is it this? I think it's this. All right, so you can see I actually wrote this short little thread on X to explain why I think Grab is extremely undervalued right now. A lot of people basically misunderstand this company and their long term strategy. There was a lot of concern over their so called slowing revenue growth. But if you break it down, you realize that their revenue growth wasn't exactly slowing, it was a slight shift in their overall strategy. So if you take a look at their annual report, you can see this here. This is the breakdown of their revenue. Singapore has actually climbed up from the third place in terms of their revenue contribution to second place, which actually shows how much Singaporeans are using Grab. And Singapore has basically only 6 million people in the country compared to Indonesia with over is it 200 million? I believe it's over 200 million people, 280 million people in the country. So it shows you that the biggest opportunity for Grab really is in all the surrounding countries around Singapore. Indonesia, 715 million, I believe, can easily reach the Malaysian levels of around $1 billion over the next couple of years. And then these are I would say the faster growing countries would probably give them the fastest growth, but at the same time, because they are in a lower SES bracket, perhaps the dollar value may not be as much, but the growth will come from there. And I think right now, what is interesting is that they have also expanded into Taiwan. And I think for Taiwan, it is a really untouched market because you see, the thing is, in Singapore, or even if you go into certain parts of Southeast Asia, you are worried that China will, have their claws in those areas as well. They have the delivery by JD Sports and by Alibaba and even Meituan. Whether or not they will go into other areas of Southeast Asia, I think people are concerned that is going to be a possibility because Alibaba is already in many parts of Southeast Asia. And the thing about Taiwan is that it's relatively untapped. I believe the other option there is like Uber, which also has a stake in Grab themselves. So I believe when Grab acquired Foodpanda, they got a pretty large market share of the existing Taiwan customer base, or in terms of food delivery. And this was a very profitable company already by itself. Foodpanda, it was EBITDA positive, so it's not as if they are going to be bleeding cash. So I think the purchase of Foodpanda itself was good. I think the $500 million share buyback program was good as well. Right. So the key metrics for me is the 50.5 million monthly transacting users. This was growing at a 15% CAGR across the last couple of years, and on-demand GMV hit a record of $6.1 billion. Now, the reason why this has actually slowed slightly compared to the previous few quarters, which you will see in the video, is that because Grab has been rolling out their affordable options in order to gain market share, they're not trying to maximize revenue per user just yet. Because right now, with where the Southeast Asian economy is, it doesn't make sense to maximize revenue per user. And right now, even no matter, even though Grab has the largest market share, the food delivery penetration is still fairly limited. We are at around 15% penetration compared to China, which is at around a 30% penetration. I believe I wrote it somewhere here. Did I, or did I not? Or maybe not. So in China, the food delivery business is really penetrated around 30% of the population, whereas in Southeast Asia, it's only 15%. And so I think what Grab wants to do is to bring the food delivery out to the slightly more rural areas of different countries so that they can increase the penetration. It's not just about market share. Yes, they have the largest market share, but that is talking about breadth, right? We are talking about in all the different countries, they are the top choice. But in all of these countries, they want to serve more and more locations within those countries as well, which makes it a lot harder for new entrants to come in and compete with them. So Grab's revenue as a percentage of GMV has been increasing. In 2021, it was only 6.5% of overall GMV. And this year, 2025, or this past year, this came in at around 15 to 18%, depending on which quarter that you were looking at. So in terms of their profitability metric, in 2022, they were down. They were negative $1.7 billion in 2025. They have finally inflected to the first full year of profitability. So again, when you take a look at the P ratio, you're going to realize that the P ratio is very, very high, which is why, like I said earlier on with the example with Zeta Global, I think a high P ratio, at least in this next 1 to 2 years, is acceptable as they turn into a profitable company. So with Grab, I've decided to use EV to EBITDA for the very simple reason P ratio is not accurate because their earnings, they basically just turn positive. So it is very, it, it's not a very clean piece of data to use their earnings because they just turned positive this quarter or this year, sorry. And then I use enterprise value because they have such a large amount on their balance sheet. Because when you use price, you're basically representing their market cap. But if you are thinking about it as someone buying the company, which has $7 billion of cash in their pockets, means half of whatever you're paying is cash, right? So their market cap, I believe now it's going to be around $14.9 billion with around $6.8 billion of cash on hand, which is around half, and debt of $2 billion, enterprise value of $10 billion, right? So in 2026, Grab actually gave us an EBITDA guidance of $710 million. And this is the midpoint of their guidance, assuming if they actually beat the high end of their guidance, which they do tend to do, then I think the valuation could be even more undervalued. But if you just take the midpoint of the valuation, $710 million, apply a 30 times multiple, you get an enterprise value of $21.3 billion, which is basically slightly more than a double from where we are today. You add back the net cash, which is $4.8 billion, you get a market cap of $26.1 billion. And compared to where we are today, this would represent a 2026 price target of around $6.44. I believe if you go into the Excel file, I got around $6.08, if I'm not mistaken. Let me go and double check. And which tells you that, using both methodologies, you can actually, because using both methodologies, you can get to more or less the same number. Let me take a look over here. Oh, this is not. Where is my graph? Here. All right, using EV to EBITDA 30 times in 2026. Okay, this was when we were not using the management's projections. We were using our own conservative projections. We got to 492, but right now we are getting to 644. Right? So let me see EV to EBITDA. What's the EBITDA number that we were using? 26. Oh, okay, because we are looking for share dilution, but now they're buying back shares. So perhaps the dilution will not be as bad. If we stick to a 1% dilution, then perhaps we will get a number closer. Yeah, I have to work this out again. 410, 710. Is there really that big a difference? But you can see basically price target should be around $6 by the end of this year. Should the macro holds up, I will have to work through this spreadsheet because I haven't updated the numbers over here. I've only done the front parts. So these numbers over here, the incentives, financial services, and all that, these are updated. Haven't updated the numbers at the back. So I will do that across the next couple of days, and we'll present to you the thesis for both Grab and Zeta sometime next week. Now, last thing I want to touch upon is basically um, Bitmine. Actually, I actually recorded a Bitmine video today talking about the valuation of Bitmine. And one of the things that I said in that video, which now I would probably have to edit out, is that I said Bitmine actually promised us Maven in the first quarter of 2026. However, if you actually read the verbiage that they use, let me take a look. If you actually read the verbiage that they use, I believe they say early 2026. Okay, let me share this with you. The company moves towards. See, Bitmine is currently working with three staking providers as the company moves towards unveiling Maven in 2026. This was just published on Monday. So on Monday, that was like the 23rd of March. I was just thinking to myself, there's just 8 days before the quarter is over. So I'm not too sure whether or not they were able to release it in this particular quarter. But sorry, based on what we see today, uh, based on what we see today, we can actually see that they were pretty quick in getting Maven together. And where is my Maven disclosures? Is it here? Oh yes, this is the one. So with Maven, you can see that Bitmine has staked 3.1 million ETH, representing around $6.8 billion at a market value of 2,148. And so Maven is designed to serve as the premier Ethereum staking destinations for institutions with a focus on security, performance, and resilience. So lower downtime, lesser possibility of slashing. They have a lot of safeguards in place, especially for smaller institutions which cannot afford to actually eat a loss on their balance sheet, and performance, which they have actually proven that over time they have generally tend to outperform the CESA ratio. And because of that, that is why institutions may want to stick through Bitmine and pay them a fee. So this was originally developed to support Bitmine's own Ethereum treasury. Maven intends to expand to serve institutional investors, custodians, and the ecosystem partners seeking the best in class staking infrastructure. So right now, if you think about it, this actually becomes another revenue source for Bitmine. So if you see, I actually posted this over here today, this morning, just before the stream. This slide actually came out during their investor day back in January, where Tom Lee was actually disclosing the four different growth pillars of Bitmine. And initially, they grew based on just the amount of Ethereum on the balance sheet. This was like in late 2025. This year, early on this year in January, they added staking revenue, right? So this is the second revenue source for them. And then on top of all of this, now we have Maven. So to me, if you ask me, I usually completely write off Bitmine's investment into their moonshot, like which means Beast Industries and Ops or WorldCoin. I totally write that off when I do my valuation of Bitmine. I only consider the three main sources of revenue, which is the growth of Ethereum on their balance sheet, the staking revenue generated by Ethereum, as well as right now Maven revenue. How this will actually play out really remains to be seen across the next couple of quarters. Hi Jess, what is my price target for SoFi at the end of the year? Now it depends what kind of market that we find ourselves in. I believe towards the at the early part of this year, I put out my price target close to around $45 to $48. If we get the war lasting for longer than that, I don't think we get to $48. I would be happy even if we just retest all-time highs of $32, $35. I am expecting new all-time highs this year by SoFi. But like I said, if the war continues, I don't think we get to $45, $48, but we at least retest all-time highs. All right. And so with that, we have been on for over an hour. We have covered most of the valuations around Zeta. I will have to put together a more up-to-date Bitmine video. So I'm not too sure whether or not I'll be able to release the video tomorrow. I will try to, otherwise it will be on Friday. All right. Thank you for being here, everybody. And I will see you on Friday. No problem. See you. See you guys.